and welcome to World Insight. I'm Tian Wei. U.S. Senator Elizabeth Warren and Bernie Sanders are calling for more action against U.S. financial manipulation. They took their cue from the skyrocketing share prices of GameStop, a video game retailer. Traders organized over Reddit and other platforms bought GameStop stocks en masse to punish hedge funds and other wealthy investors who bet its price would fall. Concerns have been growing that wild swings in prices of GameStop and other shares could trigger volatility for the broader stock market. U.S. Treasury Secretary Janet Yellen is set to meet with financial regulators this week. What's behind Reddit users' purchase of shorted stocks? Could the recent online frenzy spark new market regulations? Let's loop in our panelists. For more discussion on the GameStop in Washington, D.C., we're joined by William Li, the chief economist of Milken Institute. In New York, Professor Max Wolf, CEO of Systematic Ventures. In Guangzhou, Hong Hao, the managing director and head of research at Bocom International. Last but not least, in Beijing, Xu Sitao, the chief economist of Deloitte China. Gentlemen, what a pleasure to see all of you. May I start by asking Mr. Li, what really happened? What's the nature of this recent saga?
Well, the market volatility started with imbalances in the marketplace. A lot of people, hedge funds were short. That is, they sold a lot of shares of a very small capitalized company called GameStop. And for the first time in the history of U.S. financial markets, the retail crowd, the retail buyers, people like you and me, got wind of this market imbalance through a chat room called Reddit and some other chat rooms, and they all decided the market imbalances represented an opportunity to make a lot of money. So the force of the social media got people to start buying this company that was being heavily sold by the hedge fund, and you saw a massive upswing in these prices. And as the prices started to go up, there was a huge amount of momentum gathering, and to that point, people started to get nervous that the market may have overreacted. Prices for GameStop may have gone way beyond what it was worth fundamentally, and so there was a tug of war between the people who had investments in wanting to push up the price of GameStop and those who really wanted to push it down. This is in fact part of the price discovery process that's typical of capital markets, made an extreme by the huge imbalance that the hedge fund started with, where it shorted more than 140% of the amount of stock that was normally traded every day, and those who caught wind of that market imbalance tried to make advantage of it.
It's very interesting that the media has been portraying it as the small guy fighting the big guy, as a financial revenge against the big ones. Of course, the reality may prove a different story or different stories. But what exactly do you think, Mr. Wolf, happened? What is the nature, from your perspective, of all of this?
Yeah, so great to be here. I would say I think the media story is more, the press fell in love here with the story of David versus Goliath, with a victory for David, which of course is exciting because it's rare.
Right.
I think there's a lot of problems with that story here. One being that the largest single asset manager on the face of the earth, BlackRock, was the single largest beneficiary. So I think it's sort of David won, and you had a bunch of relatively smaller players. So I would say that the short side of the market tends to be small. On a volume weighted basis, it was very large here, but these are small niche funds. And unfortunately, a lot of what they do is provide a balance to a market in the United States that's been melting up with very expensive stocks and indiscriminate buying. So they're the sort of good guys in a weird way here, even though that's counterintuitive, in part because when stocks fall, it's the shorts who buy them. So they are important to stabilize the market. And I think we had a bunch of sophisticated players seed an idea in a bunch of small, relatively new stock traders using these free popular phone-based apps. And they were able to temporarily suspend the laws of gravity. But just as when we float high in the air on a jump or something like that, eventually the solid, heavy, dense object falls through the air. And I think we're seeing a little bit of that here too.
The law of gravity actually has always been there, and eventually it is there anyway. And we saw it over the past week. Mr. Hong, of course, you and Mr. Xu might be observing this from afar, but really, geography doesn't make a difference here anymore when it comes to financial transactions. How do you and Mr. Xu see the latest saga? How do you make up the nature of this? Mr. Xu, you want to go first, and then I go to Mr. Hong.
Sure. I think the previous two gentlemen already explained the situation quite well. This is a situation happened, not a penny stock, but in a stock without a large capitalization. I would be shocked if the same would have happened in a frequently traded stock, for example, like IBM or Cisco, right? So this is something I don't think would happen all the time. And secondly, if you look at the price, if I'm not mistaken, in the past 2 days, the share price has been hovering around $90. This has been a spectacular decline actually from the recent peak of $400. Clearly, those who paid for $40 per share, I don't think they are institutional investors. But anyway, this is still unfolding. At some point, I think there will be regulatory oversight of chat room actions. Really people, for example, four of us, we cannot correctly say we should be buying something. I think that's illegal.
Very interesting. There are a lot of issues involved here. We're going to throw some of them one by one for all of you to articulate. But let me ask you also, Mr. Hong, what's the nature of this? Your take.
Many people would like to see that, as the retail investors trying to squeeze the institutional investors. But the problem is that, if you look at the statistics, many of the institutional investors are actually making money from this trade. And the people who make the most amount of money are the ones, with the largest institution. And also, during the course of this trade, Citadel, for example, has been trying to change the trading rule by suspending the stock, et cetera, et cetera. So I'm not entirely sure that, the retail investors actually gain that much as portrayed by the media from this trade. And also, I think a trade such as this, it's unprecedented in nature, right? So I don't think many people in the market have seen this before. And I think that, the issue really is that it creates sort of a unwanted market volatility in the sense that, people who have a short position in this stock would have to sell other positions to raise capital. If they can't raise the capital, they will have to face margin call, regulatory pressure and all that. So it creates unnecessary market instability. So I'm not sure, who wins or who comes ahead, out of this trade. But I think from the market volatility we experienced in the last week, I would say that, it's the large institutions, who had the final say at the end of the day.
Yes, that is still the picture. But some would say, oh, you guys are all coming from either, larger financial institutions yourself, or, just look at your name card, or maybe involved in cooperation with them, working for them as contractors. And therefore, of course, you would talk on behalf of the big guys. What would you say, Mr. Wolf?
And there's a bit of truth to that. If you stay in the markets for a while, you usually end up working for somebody who has enough money to afford to pay you. It's another one of those sort of gravitational law of this business. I think I would say, though, that what we ended up hearing from these smaller folks was actually pretty scary. It was basically the idea that they wanted Robinhood, who was doing the trades, not to pause trading until it had the minimum regulatory capital required to pay them out. Right, which I don't think is a wonderful suggestion. There are some conspiratorial related issues here too, getting a group of people together to do this. And I think this idea of short sellers being evil and guys going long being somehow their victims is an upside down picture of the market, where the inverse is usually true. The weight of the market, the regulatory, the big players are biased to the long side. And the last thing I'll tell you is, the sadder truth about where we're at in the capital markets in the US is we have a lot of unemployed people at home trading stocks for free, hoping for a miracle. And unfortunately, I think that's the bigger driver here. And I think that's destabilizing way beyond just GameStop.
some of these small guys, quote unquote, they will come and do these things, while others say, well, you might be the eventual loser, which is apparently what's happening right now. They say, we don't care. As long as I throw the money and I take revenge against the big guys, and I feel much happy. This is not a rare phenomenon among some of the small investors that we have seen in this saga. How should we understand this?
It's really a myth to say that it's a David versus Goliath story, because quite frankly, in the history of U.S. financial markets and global financial markets, stock markets in small companies have always been very volatile. The A-share market in China is a typical example of an early stage market that was very volatile until they put limits on the degree of volatility. In the United States, small companies also are very volatile. In this case, what we saw was that it's in the grand tradition of market imbalances causing overreactions in markets. We had a catalyst in this among small people saying, we see a profit opportunity. But then a lot of the big institutions got in on that profit opportunity. So the huge volumes of trading that we saw in the financial markets was really both sides, hedge funds on both sides, trying to close that market imbalance. One interesting thing for policymakers to consider, though, is that the spillover effect from GameStop and some of the other shorted stocks didn't spill over to the broader market. The day that the GameStop was a big news, the market did go down, but that was also the day that there was announcements about how the vaccine strategy was not taking hold. The likelihood of a prolonged recession was greater because of the lack of vaccine. So there was other news that really could explain why the general market turned down for that one day. And for the last 2 days, the market's been recovering. Right. And so what good thing that we see out of all this is that the volatility is contained to those few stocks, and in a market that tries to discover what the value of a stock is, you have a lot of prices going up and down until you finally find some equilibrium. What the chat rooms did was to catalyze one side of the market very quickly, and then another offsetting force took hold from the other large institutions. But it left the realm of the small retail investor and entered the room of institutional players as soon as the volatility started to generate profit opportunities. And that's where you saw the big money come in and the huge billions of dollars come in.
So that only tells us probably one rule of the world. Some would sarcastically say, Mr. Hong, that really it is the big guys that's dominating everything. So the small investors, no matter, even if when they're united, quote unquote, as they claim this time, would not even make a difference, Mr. Hong.
Well, for now, it seems that the retail investors, had a good initial run, but then, gave all the gain back, plus some more, right? So I actually think
if not more,
retail investors are losing money. Yeah, and also I think last Friday is actually, the third largest single day surge in VIX, the implied volatility in the market in history. Right, that is huge. So I would say that it is affecting the market in a way, and also the volatility is spilling over to other names that is being mentioned in the Reddit chat board. For example, Silver, AMC, BlackBerry, and all that. So and also it creates capital constraints on many of the market makers in the market. So I would say that maybe people want to portray it as a Robin Hood, trying to get even. But then at the end of the day, the rules of the trading rules are set by institutions, and it's very difficult for the retail guys to change it.
Chat room is a word that all of you mentioned repeatedly. This time it played a very interesting role. Professor Wolf, tell me more about your thoughts regarding this social media. Has it been used by some smartly, or shall I say sadly smartly, as a tool to take advantage and manipulate the small investors and put in some kinds of mood, sensation into this, and eventually become their best source for having their stocks up and taking great advantage of the latest chaos? Not chaos, but nuance.
Sure. So, I mean, first thing I'd say is these are not investors, right? These are gamblers. And actually, some of the early guys in the space are professional sports gamblers who pulled in a couple of $1 million and then told everyone else to buy what they had to try to take the run up. And there's also starting to be some evidence that they also got out while still telling everybody else to get in there. So I think sadly, what the little retail investor did is trade an unregulated, unscrupulous counterparty for a more regulated, more scrupulous, larger counterparty, right? So the guys they hate were actually nicer to them than their heroes, which unfortunately is a story we've heard before in history. I do think social media is a good organizing tool, but I can tell you that I could get 3 guys out of my shop, and there's nothing super special about us, to use natural language processing, read this message board faster than any human being could have, front run them, and pull all the trades out before they can get to it.
Right.
So part of what you just see is a whole bunch of people like in a riot running through a hole in a fence.
Right.
So it's hard to know the long-term historical value of that, because if you start deploying technology, unfortunately, technology is also a spending war, right? So I think this is kind of a gambler's hole in the fence, and it's a great story because I think it touches a lot of the real issues of our time: inequality, a sense of frustration, the desire to use new tools to create new opportunities, when the United States is unfortunately living through a pandemic which has made our inequalities more obvious to us and more extreme.
Mr. Lee, you work for the Milken Institute. Of course, it's always interesting to see how big investors particularly, work with the regulators. How do you see the latest situation about regulation? Janet Yellen will be coming, much more visible, I'm sure, as we speak, after sworn in as the Treasury Secretary. How much are we going to see there?
Well, I think right now they're in the process of investigating. Janet Yellen called a meeting, as you know, of the Treasury officials to try to get to the root cause of some of this market volatility. Now, let's not forget, when we talk about social media in these chat rooms, we've had a social media for institutional investors for a long time. They were called Bloomberg, CNBC, BBC Business.
Fair.
We have chat rooms for professional investors where a lot of institutional analysts come on and essentially talk their book. But there's a disclosure that says, this is my book, and they're supposed to be independent analysts that give opinions for what stocks are good and good value and so on. So having a chat room is something that is an ongoing process that we've seen for forever. What's unusual about this chat room is that these are retailers who are not professional talking heads that are naturally going to be giving opinions, and the fact that they caught one trade that was a profitable trade for at least a short amount of time shouldn't cause an over-regulation of the freedom of speech that's in these chat rooms. And I think the SEC is well aware of this. The notion of what constitutes a rumor that generates market instability, market imbalances, and market fraud, those are the issues. Are people in the chat room really trying to fleece somebody to buy something that is either not what it's supposed to be, or is against their own interests? So sorting these things out in social media is going to be very difficult. But the notion of clamping down on freedom of speech is something I think that's an anathema in this country and would be resisted very heavily.
Having said that, though, we've seen with the GameStop saga, there are certain KOLs, huge KOLs, could be some of the richest in the world, but has been, having an image of the most innovative in the world, and also speak for the small guys, that are having huge impact on people's mood. Are they comparable to some of the earlier legendary figures who could be, manipulate the market and swing the market with mood to one direction or another?
No, I don't think so. The chat room phenomena that we see is something I think that's maybe just a passing fad. When once sports betting comes back, they're going to be betting on the Super Bowl just as easily as they are on GameStop. So I think as a source of financial market instability, we're going to see very limited examples of it. And I hope going forward, we're going to be able to focus on the real cause of imbalances, which is the T+2 settlement rules and the fact that the Robinhood had to stop trading because they didn't have enough settlement capital.
Yes.
If we just shrank the period for settlement, the problem would have gone away.
Tell us what eventually this tells us what needs to be observed from now on in order to make better change. Mr. Xu.
I think ultimately major central banks may really have to take a harder look at this prolonged period of low interest rate, because with such kind of liquidity, I think people always want to find bubbles. So from that perspective, I do think one of the major consequences of zero interest rate is financial instability.
And the bubble bursts. That's the problem.
Yeah.
Mr. Hong, your take.
Yeah, well, I think, to me, volatility can come from very sort of unexpected sources. For example, in this case, GameStop and other, related names. I would say that, there are still regulatory loopholes in the system that can be explored, and that can create gigantic market volatility. So at times like this, when the market valuation is very high, liquidity is still very strong, if we have some unexpected source of volatility, it could create a hole in the system. So I think people need to be, regulators need to be looking into that.
Mr. Lee.
I think the danger of overregulation from all the discussion we've heard so far is in the air. And I would be cautious about overregulating a market that has worked well for centuries. What we have to revise are some of the arcane accounting practices and settlement practices that was in the paper age and update them for the 21st century. Even Saudi Arabia's stock market had T+0 settlement. There's no reason why our technology won't allow all markets to go that way.
Last but not least, Mr. Wolf, is this the beginning of something that we still don't know, or is the end of something that's likely to wrap up very quickly?
So I think this exact trend may be fairly short-lived, but I think what it indicates, unfortunately, won't be, which is as long as there are perceived honeypots and bad guys out there, there are a lot of people with little to lose and a big appetite for fast gains. We're going to have misadventures. I think those might be concentrated more among speculators than investors. I think it's probably good for us to draw a line. One thing that is positive that comes out of this, I think, might be we might revisit the idea of an ultra short-term hold period transaction tax, where we start taxing people who hold positions for less than, say, 1 minute, which might be a good source of tax revenue to deal with social issues without over-regulating these markets. They can continue to work as quickly as they need to for the modern era.
Fascinating stuff. Thank you so much for all of your input. William Lee, Max Wolf, Hong Hao, last but not least, Xu Sitao. Thank you so much, gentlemen. Really appreciate it.